The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, investors who are managing their own money often do so because, well, multiple reasons, but one of which is they're confident that they know what they're doing and everything's going to be just fine. But it's interesting to watch what happens in the market. One of our primary market tracking software, which is readily available to anybody who wants to do this themselves.
Sure.
We'll give them a plug. It's tc2000.com. The TC stands for their old format telechart. So it's tc2000.com. If you want to know what we're looking at before we start an investment decision, that's it. But in there's a ton of intermarket data that we're reviewing. So you have to have some experience with indicators. One of those indicators is what happens to cash in the market. What we have seen this past year is that the bulk of market activity, by bulk, I mean like 80% of the money flowing in the market and the trades that are being made are being done by institutions. The money that's flowing out is all the smart investors who are managing their own money. Or they're telling their broker, get me out of this. I can't take it any longer. And if you have watched the podcast we did on Charlie Munger and Warren Buffett, it's posted right next to this one. You should watch that if you haven't done that, because I can't take it any longer is something that both Munger and Buffett figured out how to personally overcome that mistake. When something's working right, when you have a good position, abandoning it during some tough times is often a mistake. On the other hand, if your emotions don't allow for that, cash has an appropriate place in a portfolio strategy. But most of the time, cash is used as a long-term hedge, and so it's given a very minor portion of a portfolio, typically not more than 5%. But sometimes you just should not be in the market.
Sometimes that's true. The problem with individual investors making that decision, most of the time, it's a very emotional call. Most of the time, an individual investor is going to go to cash because, like you said, Don, they're saying to themselves, somebody make this stop. Let's just get off the merry-go-round for a minute and get out of the way. And it's got nothing to do with what's going on in the market. It's got nothing to do with what's available to be invested in at any given time. It's just people are too afraid, they're too scared to stay in the market, and they get too confused, and they think, well, these losses are going to continue forever if I stay in the market, so I'm just getting out. I just need to make this stop. So anytime you're making emotional decisions in the market, you're making a bad decision. Those decisions are almost never correct, and you're quite lucky if they are. So making that decision based on your recent past. The recent past hasn't been going well, therefore I'm just going to cash and I'm going to stay there. Well, this year markets are up. This year you shouldn't be sitting on large cash positions, especially right now. And a lot of people still are. Money's still flowing into cash. It just hit a record. $73 billion got moved into cash last week. So markets are moving up and people are still getting out, moving into cash because they're still afraid of what happened to them mostly last year.
So they're basically deciding to close their eyes at the current market and settle for a 5% in the money market or short-term treasuries or short-term corporates. After inflation and after taxes, and when they get about 1% return, that's not going to meet their financial goals.
That's not anybody's idea of success, right?
But it's consistent with the research that's been done on behavioral finance, people's emotional decision-making process for managing money. And the bet is that this trend continues. As we talk with other advisors around the country, they see the same kind of thing, and they're saying, well, when are the investors going to want to buy this stuff? And my experience is, and I know it's the same as yours, Perry, it's at the market top.
Yep.
Within a year of the market turning down, that's when the biggest inflow of retail investor money will show up in the market. And that adds the speculative surge that brings the final end to any bear market. Now, we have drivers that, as we look at the difficulty of the current market and the transition we've been in since October, uh, we are facing new technologies. And we've talked a lot about the Magnificent Seven or the S&P 7 plus Tesla. And those, well, other than Tesla and probably NVIDIA, because NVIDIA has come up with the new fastest chips and they resurrected what was a corporate slowing down of their profit picture with this latest innovation that generated the AI boom that we have right now. And
Right.
they are the ones that are producing the fastest video chips, which is how you go mine for crypto. I didn't know that until just a couple of weeks ago when my own computer crashed. I'm not into crypto mining. But there's new technology coming up with AI, and it's not just AI, whether people are focused on, well, what kind of AI software are you developing that's going to bring it to the masses? AI is really going to be much more important for industry, for medical, for manufacturing. It's going to make inefficient labor obsolete and raise
Correct.
profit margins. So it's not just a function of saying, who's the next great software company? It's where is this AI going to have the most significant impact on the bottom line in which industries? That's going to take some time to work out, and it's going to be, as we mentioned in the Charlie Munger video that we just did, it's going to be hard work. It's not
Lots
going
of
to
it.
be not to be just an easy ride throwing the dart up, but
Lots of
people
hard
are
work.
moving.
And AI, it's important to remember AI is not going to take over industries on its own. Like the mantra's already changed. First it was AI is going to take everybody's job, and it's already become no, it's not. But someone using AI is going to take your job. And so you're going to need to get fluent in where that's going. And that's, like you said, Don, that's another big driver in the economy right now, which means it's going to be a big driver in the market. And if you couple that, so now we have a new technology on the horizon. We have a lot of new productivity tools that are going to come online. There's going to be a lot of growth associated with that, and people who are still piling up cash positions. Cash in the market is approaching $6 trillion right now. $6 trillion of cash sitting on the sidelines. Those two things together, another transformative technology on the horizon, lots of cash sitting on the sidelines. Those are really positive things going forward. But it's not going to be without fits and starts, and no one knows exactly where the winners are going to be there. But those are drivers that are going to be consistently popping up over the next decade.
One of the things that is changing right now, and I covered this in my end of week risk on, risk off letter, is the significant change in the money going into small cap stocks. Small cap
Yes.
stocks have been a drag on portfolios for some
Yep.
time, much like emerging markets have been. But recently, in the last few weeks, there's been a shift from large cap tech into small cap companies. And the chart for comparing the two shows that small cap has almost caught up with the S&P 500. This continues. What we normally see in a bull market is that small caps lead the market. You don't buy the major index to get high returns. Small cap companies are agile. They're focused on few products. They don't have their hands, fingers, and toes in all sorts of different applications and different unassociated industries. Well, that's what you find with the big, normally in the big company, whether it's technology or anything else. They get big enough, they have excess cash coming in, and they start buying up competitors with good ideas. not
Sure.
to develop the good idea, though they promised to do that. That's how they managed to buy the company, but to take it off the market. And if there's something there they can use, they might incorporate it back into their company. But the little firm that got bought out, the guy's happy because he has a ton of money. He's got $100 million, which he never thought he'd saw in his lifetime. But he's lost control of the company and his ideas. He has to start over someplace else. But the small companies, knowing that they're focused on something, their big problem is getting enough money to expand the company. Venture capitalists start that at some point. They start borrowing money from alternative sources, and then the mid-range banks. They get listed. They get an IPO done, and they can raise money from the public. Those guys are where the future of AI is going to be maximized. So you have to take your eyes off the big guy on the street, do some work, and find where development is actually occurring in a real life situation, not just to make your typing a letter or your term paper easy.
Right, right, and that's important to do. It's important to get a little more context, take a wider view, and we do that by watching, well, where's the cash flow. We follow the money. We follow the money into the market. We look at where's that growth going, and like you said, Don, that small cap sector had been lagging badly for years now, and now it's that trend is starting to correct itself. And as usually happens in a bull market, those small cap stocks begin to attract money, and the good ideas get rewarded. That's the whole system of the risk premium in the stock market, is that those good ideas get rewarded, bad ideas end up with losses, and because no one lines up behind them. But you follow that money, you follow the trend by following the money, and that will put you in a better place to look to going forward with a higher probability of success. And like you said, Don, it's not always in those big companies. It's the Magnificent Seven is not going to stay at the very top of the market forever. They're going to get smaller companies that disrupt everything going forward. And we're in that kind of environment where that can happen. AI is going to drive things nobody thought about yet. $6 trillion in cash sitting on the sidelines to fund whatever looks like the next hot thing, and it's going to happen that way. And it's important to be nimble and important to be paying attention to where that cash is going.
Well, and right now the current forecasts favor domestic equities over international.
Correct.
The high interest rates have placed an increasing amount of risk with international investments because it's making it difficult for international borrowers to pay the interest, much less pay back the loans that they have used during more than a decade of zero interest rate policy at the Fed. And there is a shift that is occurring with internationals that are trying to find ways to do commerce without using the US dollar. More and more of
Right.
them are doing so. So the petrodollar, which used to be the only way you managed to buy energy, has competition today. And I don't think our government has figured that out. So this is a function of paying attention to actually what's going on in the market rather than buying into a long-term, quote, risk managed portfolio because we are going to diversify through asset classes. Well, some asset classes shouldn't be in your portfolio. When we're talking about the Magnificent Seven or the S&P 7 dominating the stock market today, both on the NASDAQ and the S&P, we only have to go back a couple of decades. And today's smallest sector in the market is energy. And it used to be what we would now call the Magnificent Seven. I don't know if there were seven companies, but you take Exxon and Mobil and Shell, BP. Energy was the largest sector of the market. It no longer is. These things rotate, and the average investor isn't paying attention to this. Short-term volatility drives fear, and the fear drives the cash, and that fear mitigates after there's been several years of a market advance. And then they say, well, the danger's over. But the probability at that point in time of a market downturn has increased significantly from where we are today. with small caps rising and tons of cash on the sideline, institutional investors, while they have tight limits on what they're going to pay for something, are buying into the market. We are being set up not for another bear, but for the beginning of another bull market. And most investors are going to wait 4 or 5 or 6 years before they take the cash off the sidelines and
Yeah.
decide to
Yep.
nibble back in. You don't want to be one of those.
Right. You need to be ahead of it. You need to be thinking about where things are going and react to what the market's doing. That's all you have to do. React to what the market's doing, not to what the market has done. And that's what so many people do with that pie chart investing is look at history, invest the same as if the future is going to be the same as the past. And it's not even going to be similar. They say history never repeats itself, but it rhymes. And more these days, it doesn't even rhyme. It's something brand new that comes on the scene. And you need to be ready for that. You need to be paying attention. Watch what's going on with cash flows, follow the money, and believe the market trends. When you see those occurring, you have to be willing to follow the market trends. That's telling you the truth about where things are going.
Well, that requires that you develop a system, a process that you're comfortable with. Do you understand how to monitor it? This is not a market made for sluggards who want to go to sleep, sit, and assume everything will be okay. There's still a great deal of uncertainty in the financial markets, the geopolitical markets, the global economy, one of which is the major driver of even our economy has been access to cheap products, mostly made from China. Well, China is on the verge of entering into a deflationary scenario, and they have an excessive amount of off balance sheet debt that is, well, it's in trouble. I can't say it's starting to be because this process started with COVID, and it's
right.
getting worse. The People's Bank of China is trying to intervene to stop this from cascading into a bigger problem. But disinflation turns into deflation, and deflation is not reversible by a central bank. It requires new confidence coming from consumers, and China is struggling to turn that issue around. If that doesn't happen, then your investments, assuming you have some in foreign markets, are facing some significant headwinds. Probably you should reevaluate whether or not you want to hold them. The U.S. market, on the other hand, has a high degree of confidence in consumers that continues, despite the fact that they're using credit cards, or many of them are, to get through this period of time. Inflation is coming down. It does look like the Fed will reduce interest rates before very long. Now, before very long may be 25, but it's not likely Wednesday of this week.
Correct.
We'll find out. We're recording this on Monday, so it's unknown. But that's our expectation. What our expectation is irrelevant to what's leading in the market. We want to own things that are working, and when they quit working, we want to get rid of them. Rotate the portfolio. Forget about long-term asset allocation decisions. This is a dynamic market that's trying to figure out where the AI revolution is going to have the biggest impact. And it's not necessarily with the big tech companies. It's going to happen in other industries. If you don't have a process, we do. You can contact us. The information's on the following slide. Thanks for being with us. Have a great day. Subscribe if you haven't already.